Thank you for joining us on Minds of Commercial Real Estate. Today we have Shawn Daei from Allied Tax Group. Shawn, thank you for joining me.
Thank you for having us.
You got what I want, got what I want. You give me just one look and you know I'm good to go. You know I'm good to go.
A little background on Shawn. Shawn is an accountant, an EA enrolled agent.
Correct.
And deals with a lot of clients in different fields. But I'll let Shawn, you give us your background, where you started, how you ended up where you are today.
Yeah. Thanks again for having me. A great honor. And I appreciate, the opportunity to be here.
Thank you.
So a quick background on me. Graduated essentially from college back in 2003. And then ended up joining the IRS in 2005. Worked as a revenue agent, which is an auditor essentially, for the Internal Revenue Service for about 8 years. Essentially left the service in 2013 and opened my own firm. So our firm has been around for about 12 years now, a little bit. I'll go into almost 13 years. But I've been doing accounting and taxes for, a little bit over 20 years now. I got into taxes just because I realized that it is a big aspect of everyone's life, especially if you have a small business. It has a huge impact on your life, on your daily activities, how you essentially take care of your family members and everything that impacts it. So for me, that was very personal, and it was very important for me to really understand how the tax system essentially works. We specialize essentially in sort of the higher net worth individuals and helping them keep more of their hard-earned money. That's where we sort of shine and we add value.
Great.
Yep.
Thank you for that.
Sure.
Let's jump in a little bit into this new bill Mr. Trump put for us, the big, beautiful bill, and some of the main key points from it. And, it's going to be implemented obviously in the 25 tax returns, but what are you seeing? What are the biggest benefits for the people out there?
Absolutely. The One Big Beautiful Bill Act, OBBBA.
Yes.
That we essentially got passed this year. A couple of the huge key points, especially again for small businesses and sort of some individuals. The bonus depreciation, which is, we'll get into that a little bit later.
Sure.
But the bonus depreciation is now back at 100% for any assets placed in service after January 19th of 2025. So
Huge.
yes, absolutely. So for anyone that's looking to expand or sort of replace any of the older equipment, any of that information, that 100% bonus depreciation is extremely valuable. And then for the folks that are sort of new to this realm, bonus depreciation or the write-off is essentially at the federal level. If you buy, and again, this can be confusing to some, so I'll go a little bit detailed.
Sure.
You don't have to put the entire cash up front. The equipment could be financed. But as long as it's purchased and placed in service, you can now deduct 100% of the cost or the value of that asset. So for example, you buy an asset that's $100,000, you finance it, you put 10% down, $10,000 down, and you finance it over 15 or whatever years you end up financing it at. The write-off from that particular asset placed in service is $100,000. So if you had $1 million in revenue, now your revenue, your net income is reduced by $100,000, which is huge. Right. So for a $10,000 deposit or down payment, you get to essentially write off $100,000 off of your income.
Of expenses.
Of expenses, correct.
And this is only for 2025?
No, it's actually going to be continuing for 2025, 2026. So yeah. But one of the key points is it's implemented in 2025.
Got it.
So it's right away. A couple other things that the One Big Beautiful Bill Act passed. The state and local income tax, that was essentially capped at $10,000 before. So if you're an individual that was itemizing your deductions, your state and local income tax, also known as SALT, which is your real estate property taxes, your state income taxes that you paid. On the 1040, that was capped at $10,000. So now that has been raised to $40,000. So much better deduction for individuals that are itemizing own their own primary residence, and huge tax break essentially on that.
Got it.
Yeah. So a few other components. I don't know how much time we have to get into it, but
Sure. You can continue. The main point I'd like the viewers to know, and get.
Yeah. I mean, the best one right now, the one that's sort of a home run for essentially for all of us, is the bonus depreciation.
Got it.
Because we get to take advantage of that. And
what about how does that play with the cost segregation?
Right now, as we're recording, this is November 5th.
Correct.
So hopefully all the viewers are now connecting with their accountants and doing the year-end projections. And one of the key points that you want to take away from here is you always want to be proactive.
Right.
So when we meet with clients, we always explain to them any kind of a tax planning that's worth doing and worth investing in is done between January 1st and then 12/31, because most of us are on a calendar year tax basis.
Right.
There are certain folks who are not on calendar. We can discuss that later. But for the majority of our clients, the majority of the clients that I've met throughout the years are from January 1st to 12/31. So any sort of tax planning that needs to be done must be done within these two periods, from January till December. Why is November so important for us? Is because most of the year has already passed. And hopefully your bookkeeper, your accountant, whoever is doing the books for you, the numbers, can give you a nice report. Then you can take over to your accountant and review that deeply with them. And now you can see November, January through November's numbers, or October, we should say.
Right.
So you have most of the years passed. You can project the next few months based on history, based on trends, based on whatever needs to be done. And you can have a stronger projection numbers for 2025, which allows you to now decide what sort of tax planning you can do. One of the ones we implement often is a cost seg study. And for the viewers or the people that have not heard of that, cost seg study is an extremely powerful planning tool that could be utilized to reduce your taxable income. So remember, taxes are essentially a game. If you know how to play it and you know how to maneuver it, you can win. And cost seg study is an extremely powerful tool. Going back to the cost seg study in combination with the bonus depreciation.
Right. So
cost seg studies are, if you think about it, when you buy a building for investment, whether it's a commercial building or a residential property, from the Internal Revenue Code, it's one component, meaning that it's one building. So the purpose of a cost seg study is that usually there's a qualified engineer involved and there's a team involved. What they do is they come in there and they break this one asset into different components. So the cost seg study people, they come in and they say, okay, we see a building, but that building has 15 windows, 25 doors, has electrical panel, electric components, has a lot of different plumbing parts. So they literally take that asset and they segregate them. So you might ask yourself, okay, what's the big deal in that? The beauty of that is when you buy a commercial building, you can depreciate over 39 years. When you buy a residential building, it's 27 and a half years, meaning that asset can be straight line depreciated over 39 years. I'm just going to use a commercial building for this example. Cost seg study people, they come in and they say, well, now those assets are no longer 39 years. They're going to be classified now as 5, 7, or 15 years. Again, you're like, all right, a little bit faster depreciation, great. But the beauty of it is now we take that 39-year asset, we cost seg study it into different components. Now those components now qualify for bonus depreciation, which is huge.
In addition to the other.
Correct.
That was implemented.
Correct. So for example, you go and buy a building. I'm just going to use California numbers.
Right.
Something very inexpensive, $5 million.
Sure.
Which is a starter commercial building these days.
Right.
You buy a $5 million building. And again, you don't have to pay for the entire thing up front. You can finance it over how many years, whatever it takes.
30 or 25 years.
Correct. Different loans. So now you come in there, you buy a $5 million asset. that's supposed to be depreciated over 39 years. You do a cost study. So now those components are broken down to different parts. And I'm just going to use an example. This is, don't take my word for it. But now that $5 million asset gives you about $1 million of bonus depreciation in year one.
Just huge.
Huge. So think about it. You have a $5 million building, a great asset to have anyways. You get $1 million deducted from your taxable income.
Off the top.
So you can ultimately, which I've seen a lot of clients legally, again, do this. You can literally drop down your federal income tax to zero by taking these steps and planning appropriately.
How many years can you carry over if you're at zero? The segregation.
As long as it's there, it's yep.
You can carry it over.
You can carry it over.
Well, that's great information.
Yeah.
How often should a average, business owner do tax planning?
I always like to explain it's not a one size fits all.
Right.
So obviously, if you have more entities, more activities, you're doing a lot more, then you want to be in connection with your accountant or CPA more often.
Okay.
We always like to say if there's a life-changing event, we have to know about it before it happens.
Right.
It's a joke in our office. You should have known.
Right.
But you don't want to let your accountant know after the fact that you have, for example, purchased something or
plan it ahead with.
Plan up ahead, talk to your accountant, make sure it's properly done.
Right.
And meet with them as often as you need to make sure that things are going smoothly.
Got it.
Things happen often.
Right.
We just had a client or a potential client call me a few weeks ago, actually. Wealthy individual, his dad, essentially, which was the last parent, essentially left.
Mm-hmm.
So the we won't get into trust and estates, but that's important for estate planning. The last parent,
Sure.
if they pass away, that means everything's executed.
Right.
Passed away over a year ago, so calendar year 2024, and the individual is a doctor, super busy with the practice, super successful. Never took any steps to sort of check with the accountant of what's going on with that sort of estate and, tax planning purposes. So once we had the initial conversation with them, this was brought up to me. I said, well, this should have been done in 2024 because they could have been distributions from the trust. There could be a lot of different things that impact your individual return. So going back to that life-changing event, if you have a parent, God forbid, passes away, this is something that your antenna should go up and say, I need to discuss it with my accountant or your trust attorney.
Right. Which they should have done before, God forbid, the parents had passed away.
Correct. I mean, this individual is older. They sort of knew that, so it wasn't a sudden death.
Got it.
But, which makes it even a little bit more difficult that they should have communicated that with sort of your team members.
The trust and
the trust attorneys and the accountants.
Along with the CPA.
Correct.
Got it.
Very, very important to sort of be proactive. Again, that's the word I like to use often.
Right.
You have to be proactive when you're doing your.
Right. What is probate today on the trust?
I think it's over 15 million. I don't know the exact number, but it gets adjusted for inflation. Yeah. It was raised again. Yeah. It's huge.
I mean, the average.
We are in Southern California, right? 15 million these days.
Yeah. And then Southern California is nationwide, though.
Correct. Correct. It's not a whole lot. But Southern California always shocks me and surprises me.
Absolutely.
There's a lot of individuals walking amongst us who are wealthy and they just live a very average life, and we would never know that.
Correct.
Yeah.
Correct.
But it's a lot. So I took a few courses, and one of the courses I took just for knowledge information was trust and estate, just to familiarize myself with it, because I always like to know more. Right. I'm always eager to learn. One of the interesting things the professor which was a very famous trust and estate attorney, came and said essentially, which is, he said, most of you guys are here just to learn about the trust and estates. You're not going to actually do any client work, because if the client has any money, I probably know about it, or I'm their attorney.
He's telling you his experiences.
Yes.
Yeah.
So that was an interesting point.
But it is important. I mean, you'll probably get a lot of clients that don't have trust, even for the simplest W-2 earner to multi-generational, businesses. It's very important for them to have trust. And I personally, I see a lot of clients that still don't have trust in the higher echelon, lower echelon, and I'm telling them you should definitely speak to your CPA and get a recommendation for trust at any level.
100% I agree with you on that, just because things happen often.
Sure.
Unfortunately, especially if you are, I'm 46. A lot of my clients are very similar to my age, and we're all getting to a point where we have kids and we have sort of more obligations and more duties. And you're right. It still shocks me that I get very successful, highly successful individuals that come to my office who don't have any trust for their family.
Right.
And God forbid something does happen, it can end up in probate court. So I have this conversation with them, and it's a tough one.
It is.
We always say when they come to sort of in our office, kind of like going to a personal trainer.
Mm-hmm.
The first week, you're going to be in pain. It's going to hurt a lot, but hopefully over time you're going to realize it's for you. It's for your benefit.
Yeah, and it's
for your family.
Correct.
So yeah, that's I've seen a lot of business owners that come through with different business partners who don't have a buy-sell agreement.
Correct.
They don't have anything in writing because they started their business and everything was rosy. Now they're sort of grown to a point and they have different point of views in life. They want to go maybe their separate ways, but they're having a hard time separating just because there's nothing in writing.
Right.
So
who takes what?
Proactive planning
Correct.
in the beginning is extremely important. And then, going back to the trust, very, very important, especially if you have a family.
Right.
You don't want your kids, God forbid, to sort of
deal with the courts.
Exactly.
Especially if you're under the 15 million mark.
Exactly.
So Shawn, what is one story you can share that you've seen which can be very beneficial and could be, that could have been, prevented, let's say?
Yep. Excellent question. I love that. So one of the ones that really sticks out in my head, and it's been many years actually, but it's still fresh in my sort of top of my head. I had a lady call me, was referred by a friend of mine. Her dad had passed away, and we were going over some of the documents, and she inherited. Well, here's the issue. Before the dad passes away, they thought it was a good idea to go ahead and sign the building. It was a commercial building, LLC. They thought it was a good idea to go ahead and essentially gift that to the daughter, which is a common mistake a lot of folks do, just because they're like, hey, we're not doing well, and we want to make sure that this transfer is done properly. So instead of going through proper channels and hiring the right people, they thought it was a good idea to go ahead and just gift the building, which at the time the fair market value was about a few $1 million, $5 or $6 million to be exact. Building had no loans; it was paid off for, and they thought it was a good idea to go ahead and gift that building over to the daughter. What ends up happening is now, since it's a gift to the individual, before the death, that particular person doesn't get the stepped up basis. And stepped up basis, or basis in an asset, is essentially, for tax purposes, what is the cost of the building to the individual. So for example, if the building was bought a long time ago and they had taken a depreciation down all the way to zero, when you go to sell the building, okay, let's say, for example, $6 million, the capital gains are calculated at sales price minus the basis.
Sure.
And the net gain is calculated based on that. So this individual, if she had sold the building, for example, $6 million would have been entirely taxed.
Right.
If she had consulted or talked to a estate planner or a trust attorney, they would advise her to hold on to the dad to hold on to the building. When the individual passes away, that resets the basis back up to the fair market value. So now at that day. So now the building of $6 million, she would have gotten it after the trust has dispersed it. But then her basis would have been stepped up to $6 million. And when she sold the building, she would pay zero.
Sold it for $6 million, or it'd be 6 minus 6 or zero capital.
Exactly.
gains.
Exactly.
Huge mistake.
Huge. And we sort of talked to a lot of attorneys back in the day, and there was no way around it because it was clearly transferred before the death. So the basis was transferred over. The dad's basis gets inherited or transferred over to the person that's being gifted to.
Right.
And they don't get the stepped up basis necessary.
Simple mistake, cost them probably $2 to $3 million.
Yep. 20, I don't know what the capital gain at the time was,
Correct.
but correct.
Could have, around there.
Yep. Federal and state combined tax could have been avoided.
Right. So please consult with your CPAs, consult
100%.
with your accountant, consult with the trust attorneys, anybody before you make any such moves.
Exactly. Very, very important to consult with them proactively and make sure that things are done properly before you do it, because there are certain things that are not reversible.
Right.
Especially
will
if you
cost
tell
you.
someone, it would cost you a huge amount.
Right.
So that really stuck with me. And I've seen many, many over the years, very similar stories or similar incident situations that unfortunately could have been avoided if the person had sought proper legal advice or accountant or whatever needs to be done.
Something that might cost 5, 10, 15, 20,000 could prevent millions of dollars in IRS owings.
Correct.
Well, thank you, Shawn, for all the valuable information. Look forward to having you, in the near future. What is the best way for, individuals, viewers can get in touch with you?
Best way to get in touch with us is our website. It's www.alliedtaxgroup.com.
Perfect.
And then we have a link there. You can set up an initial consult with us.
Great.
We can discuss whatever, and then we'll be more than glad to help you out with any services you guys need.
Thank you. Appreciate
Thank
it,
you.
Shawn.
I appreciate it.
Thank you for watching. If you enjoyed this episode, please give us a thumbs up, subscribe, share any questions or comments in the comments below, and follow us on social media. I look forward to seeing you next time.